Hello, sports fans. Derek Eichenwald here, Tax Strategies. Let's jump into it. Welcome to the presentation. Happy Valentine's Day. I know I'm one day early. Let's kind of get into it. We're starting a few minutes late. We have a lot of people inside of the meeting this evening. And as I said in previous presentations, I tend to get lengthy. However, I will keep this within the hour. That is my goal, my New Year's resolution for 2024. All right, well, let's get going here. First thing that I always start with is disclosures. Triumph Capital Management is a registered investment advisor. We're located, our home office is here in Denver, Colorado. Today, I'll be making some comments. I'll make a few comments about the market. I did add a slide in there today, but I'll also be making a lot of comments about tax code and strategies around the tax code. These things are subject to change, and no tax management strategy is perfect for everybody. It really, really does depend upon your specific circumstances in that particular year, as you will see as we work through these slides. For those of you inside of the call this evening who don't know me, my name is Derek Eichenwald. I have the distinct pleasure serving as the Chief Executive Officer of Triumph Capital Management. If you hear an accent, I'm originally from the East Coast, Massachusetts, Boston area. I've been out in Colorado since 2002. So I probably lived here in Colorado longer than I had lived in Massachusetts. Because of what went on in the markets today, typically I would leave this presentation simply for taxes. However, because of what went on in the markets today, I wanted to make a few comments. Today, here's what the markets did. You saw the Dow Jones Industrial lose about 530 points, as the screen shows, or 1.34%. You see the S&P 500 was down 65 points, losing about 1.3%. The NASDAQ was down 273 points, or 274, losing close to 2%. And the Russell 2000 that focuses on small stocks lost nearly 3%. Why? Why did that happen? Well, this morning at 6:30 Mountain Standard Time, 8:30 Eastern Standard Time, we got the annual inflation data. Annual inflation data came in at 3.1%. That is core, that strips out food and energy. Of course, for those of you who know, the Federal Reserve has a dual mandate. That dual mandate is to have inflation at 2% and have unemployment at 4%. And although we have seen inflation come way, way down, back in June of 2023, we got a high rate of inflation, close to 9%. And as the screen is showing and as my slide is showing, we've seen inflation come down. But today, with the reading at 3.1, expectations were that we had a reading of 2.9. Because of that hot inflation reading, you saw the market sell off. Why would the market sell off with that hot inflation? Well, as many of you know, the Federal Reserve over the last 2 years brought the federal funds rate from 0.25 all the way up to where it is today at 5.5. The market expects the Federal Reserve to cut interest rates someplace between 3 to 5 times through 2024. Now, that certainly could happen, but if you have inflation that isn't continuously getting lower, the feeling is that the Fed will keep rates longer for higher, and that you might not get that 3 to 5 cuts in 2024. Of course, today, with the consensus being that we'd see core inflation come in at 2.9, and we got a core inflation reading of 3.1, markets sold off. I won't go too much more into that, but what I will say is, for those of you who maybe are on a first-time webinar, or you're kind of like, hey, that's interesting, If you go to our website, as you can see on the screen, the website's www.triumphcapitalmanagement.com, and you click on the free webinars area, that page will load up. As you can see on the screen, you can see today's webinar. It says upcoming, but of course we're live right now. But below that, you have all of the past webinars. On January 30th, I did a webinar, 2023 in review. When I reviewed 2023, we also talked about kind of the first month of the 2024 markets. In there, I give a pretty in-depth discussion about what I just talked about, the Federal Reserve, interest rates, our expectations. In that, I did say I expected to see inflation come in a little hot. I expected the markets to sell down due to the fact that inflation was going to be hot, and I don't know if we'll see those 3 cuts in 2024. We absolutely could, but of course, with the little data point today, inflation's sticky. I make a lot of comments on that if you were to go back and watch that past webinar. By the way, on the website, when you're in there, you simply click on it and it'll start to play for you right on your computer. All right, well, let's dive into it. Let's dive into tax strategies, because I got to get you out of here in the next 50 minutes, and I will try to be quicker than 50 minutes. So let's dive into it. First things first, I always like to think about where we were, where we are, and where we're going. So I always like to start with a little bit of history. If I go back and I look at history, the first income tax proposal was in 1814 to help fund the War of 1812. That never happened. In other words, Americans were never taxed because of the Treaty of Ghent. It ended in hostilities in 1815, and because of all of that, the United States kind of just said, hey, you know what, we're not going to tax you. The first income tax that went into effect happened after President Lincoln signed the Tax Acts of 1962. This law set a 3% tax rate on incomes above $600 and a 5% tax rates on incomes above $10,000 at the federal level. Records show that very few Americans actually filed a tax return back in 1864. The Act of 64 raised taxes to continue funding the Civil War. That was one of the big reasons for it. Following the Civil War, the public began to lose interest in income taxes. Not that they were that interested in it today, but that was the public sentiment. And several attempts were made to make the act abolished. Well, anyways, in 1972, the government repealed the act, and new tariff restrictions provided the nation with revenue. In other words, they got rid of tax revenue by taxing Americans, but they had tariffs on imports. And really, that was the source of tax revenue, if you will, tariff revenue for decades. That was all ratified in 1913. It gave Congress the authority through the 16th Amendment to tax American citizen income. Tax rates have certainly fluctuated over time, and the federal government, we go back and we look at the 30s. Taxes from Americans represented less than 1% of our GDP. But by the time we got into the 50s, it started to represent nearly 9.2% of our GDP. And that has kind of continued. We've seen tax revenue kind of grow over the years. And it's estimated that when we get to 2027, just a few years from now, individual income taxes will represent north of 11% of the United States GDP. We don't collect this data all the time, but if we go back to 2022, so just 2 years ago, the United States government collected from individual income taxes. That doesn't include your sales tax at the store, so on and so forth. So just individual income taxes, those tax returns you were all about to file, $2.63 trillion, $2.63 trillion of individual income taxes collected back in 2022. Next, if we look at this chart, we can see that marginal tax rates on top earners have varied over time. In 1915, as I mentioned earlier, right, they just kind of started doing taxes in the 1860s. But when we got to 1915, the top tax bracket was at 7%. During World War II, the highest marginal tax rate, when I say marginal tax rate, I'll explain what I mean by that in a second, it jumped all the way up to 94%. It dropped slightly in the years after World War II, but rose again and stayed high throughout the 50s. Despite being at 50% for most of the 80s, it dropped and stayed at 28% for 3 years during the late 80s before rebounding back to 39% in 2015. And then tax rates were again cut by President Trump. And in 2023, the highest marginal tax rate is 37%. Let's take a look at that. What I mean by that is in 2023, what you see on your screen right now is federal tax brackets. The way that this works is if you look at the chart, let me move some things around on my other screen. If you look at the chart, the way that taxes work, a lot of people kind of don't necessarily understand this. You maybe have heard folks at work say, well, I don't want to work overtime because if I do, it'll put me in a new tax bracket. By the way, that's silly. Let me simply explain. First thing that I'll explain is we have a progressive tax system. What I mean by a progressive tax system is you, me, and Warren Buffett, we all pay the same amount of taxes on the income that we earn progressively. What I mean by that is if you file as a married filing joint or a single filer, head of household, or if you're married and you file separately, these are how the different brackets work. Let's focus on married filing joint. Well, if you take somebody who earns $100,000, their first $22,000 of taxable income is taxed at 10%. Then their income between $22,000 and $89,000 is taxed at 12%. Their income over $89,000 all the way up to $190,000 is taxed at 22%. Point being is me, you, and Warren Buffett, if we're all filing married joint, on our first $100,000, we all pay the same amount of income taxes. It just so happens that Warren Buffett makes a whole bunch of income over $639,000, and therefore a lion's share, if he makes $10 million a year, is taxed at 37%. Earlier, when I was referencing marginal tax brackets, and I said the highest marginal tax bracket in 2015 was 39.6%, and then President Trump brought tax brackets to what you're seeing today. What I meant by the highest marginal tax bracket was this. Highest marginal tax bracket today is 37%, okay? Some quick facts for you before we get into strategy. Americans who earn more than $200,000 per year, okay, paid over 65% of all federal income taxes. Americans who earn below $30,000 per year paid less than 1% of federal income taxes. And Americans who earned more than $2 million a year, but below $5 million a year, accounted for, about 8% of all federal income taxes. The reason for that is because of the progressive tax nature. Higher tax earners pay a lot more in income taxes, okay? Let's talk about the agenda for tonight. I have 3 key points for you. The first thing that I want to talk about is types of income and how it's taxed. People are confused about this. Understanding this will help you position your investments wisely. We'll talk about it. I'll show you how that positioning works and how to reduce that taxable income. We'll talk about a lot of various strategies. This is where I may get lengthy, but I got my eye on the clock. So let's talk about the types of income. The first thing that I'll talk about is earned income, or really, I guess what I'll say is there's 7 different types of income. There's earned income. That's the money that you earn from going to work, so on and so forth. What is also earned income is a lot of 1099 income. At the bank, for instance, for the first time in my career, I've been doing this now for about 22 years. But for the first time in my career, at least over the last 2 years, I've been able to say to folks, hey, your bank account's paying you something. It's paying you some interest. For 20 long years, your bank account, I would make the comment, it does nothing for you. It earns zero. Well, that income that you make inside of your bank account is interest income, but it's treated as earned income. I'll unpack that a little further as we keep working. There's profit income. That could be profit income from selling a business or an asset. There's interest income that I just talked about a lot. There may be royalty income. There's dividend income. There's rental income. And there can also be capital gains income. All of these different things are taxed differently. Well, if I really think about it, I'll think about the big four. The big four: earned income, interest income, dividend income, and capital gains. Let me explain. Earned income, that's the money that you get from going to work. That's the money that you get if you're collecting Social Security or a pension. That is all considered earned income, at least from a tax perspective. There's interest income. Again, I just explained that. That's interest that you may be getting on your bank account or inside of a money market and that type of thing. That interest income is taxed the same way as earned income. I'll unpack that as I mentioned. There's dividend income. We'll discuss how dividend income is taxed. And then there's capital gain income, and capital gain income can be both short-term and long-term. I'll unpack that as we work through stuff today. So again, 2023, the federal tax tables on earned and interest income are this. In other words, if I go back to my previous example, a married couple earning $100,000 a year, everything that I ran you through before. But now let's say they had 100 grand in the bank, and through 2023, that bank account paid them 5%. Well, that bank account income is added to these tax brackets. In other words, it would be as if they made 105,000, and that 105,000 would work its way through the federal tax brackets. Okay. One thing that I want to clear up is your tax bracket versus your effective tax rate. Let me explain, because people are confused about it. Before I explain that, I made the comment earlier, and the comment that I made earlier is you heard people say, hey, I don't want to work in overtime because it will push me into the next tax bracket. Let me unpack that for a second. Let's say the person who made that comment is married filing jointly, and by working overtime, their income for the year ended up at $89,451. Only that additional dollar is taxed at the 22% tax rate. It's not as if their other income is taxed at the 22, only that additional dollar. Which also leads me to this. Let me say this as kind of a case study. Let's say you have a married couple, they make $200,000 a year. Well, because they make $200,000 per year, okay, as a married couple filing jointly, they're in the 24% tax bracket, right? They made 200 grand. That's the tax bracket that they fall into, okay? But the question is, what is their effective tax rate? In other words, when you run that $200,000 through the progressive tax rates that we have here in the United States of America, okay, what is their effective tax rate? Well, when you do that, their effective tax rate is only 17%. In other words, they earned $200,000. Their income falls into the brackets in this fashion. This is the amount that they owe to the federal government, $34,800 divided by their income of 200 grand. Their effective tax rate is 17. I'm clearing up some things that a lot of people don't know, and you may be like, hey, Derek, that's all great, but how does this play into my investments? Trust me, we're going there, but it is prudent that we kind of clear up some of this stuff. Anyhow, let's keep working here. My pointer's acting up on me, so I apologize for that. Okay. All right. What a lot of people don't know is that we actually have two different tax brackets in the United States of America. I just spent some time discussing what your federal tax brackets look like. I also made the comment earlier about capital gains and dividends. There's a separate tax rate. Now listen, prior to President Obama, it used to be really simple. The money that you got in dividends, what is a dividend? A dividend is typically paid by a company, a mutual fund, or an ETF, was flat taxed at 15%. Flat taxed at 15%. When Obama was in office, he passed a tax code that did something to dividend rates. What it did to those dividend rates is it said you could pay as little as 0% in dividend rates or as high as 20% in dividend rates. It depends upon the way that you file. In other words, if you have a dividend from a company, is it going to be taxed at 0, 15, or 20? Well, the way in which the tax code works today is it says, okay, we're going to look at all of your income. So your earned income, that may be what you're receiving from work, pension, Social Security, a combination of the three or just one. All of that interest income that maybe you earned inside of your bank account or inside of a regular investment account. And then all of your dividends, all of your dividend income. And depending upon what all of that income adds up to will dictate what that dividend tax rate is. So if that all added up, again, this is married filing jointly over here, if all of that income added up to less than 89,000 bucks in 2023, you actually pay 0 taxes on that dividend income. If that added up to less than 553,000, you would still be at the 15% rate. And if it added up to over 553,000, unfortunately, you're up to 20%. Does that make sense? The next thing is capital gains. Okay, what is a capital gain? There's short term and there's long term. Let me explain. A capital gain is simply you selling an asset. What I mean by you selling an asset is it could be any asset. Let's use a stock because that's typically what I'm talking about when I'm talking about capital gains. You bought a stock at $10 and you sold the stock at $12. Therefore, you have a gain of $2. The question is that gain short-term or long-term? If that gain was realized, now what does it mean to be realized? You maybe bought a stock for 10, it's now worth 12. That's inside of your account. That's a 20% rate of return. However, you haven't sold it. You bought it in the year 2000, and let's say today, 2004, it's worth 12. You still haven't sold it. You're not taxed on it until it's sold, until it's realized, okay? Now, when it is realized, the question is it short-term or is it long-term? If you've realized it before a year and a day, 12 months and 1 day, in other words, you bought it at 10, sold it at 12, and that happened within 12 months, it's short-term. If it is short-term, your tax, it's part of your taxable income. You're up here in these tax brackets, okay? However, if it is long-term, meaning you've held that asset for 1 year and a day, it is then taxed at these tax brackets. Again, the worst one being 20%, but often if you look at this, it's better than it being at these higher rates in the 30s. So I wanted to unpack capital gains and dividend rates, okay? Let's talk about the concept of tax-exempt income. Tax-exempt income. Tax-exempt income could be income that you receive that isn't subject to taxation. What may be an example of that? An example of that may be a municipal bond. A municipal bond is typically exempt from federal income taxes. In other words, if you own municipal bonds and you receive income from those, they often, not every time, but often are tax-free. In other words, they do not fall into your tax tables. Now, here's a concept for you. This is one of the first concepts I'm going to make as tax relates to your investments. And this is very prudent for the time. What I mean by very prudent for the time is I mentioned it earlier. For 20 years of my career, I would say cash does nothing for you. It earns basically zero. Today, okay, we're looking at money markets. I looked at the money market rate today, and money market rates were around 5.4%. So I have a question for you. The question is, if I came to you and you had $100,000 to invest, do you want to earn 4.2% on your money or 5.3% on your money? Well, the answer to that question is very clear. You would immediately say to me, 5.3. Wouldn't you? You would. However, that may be a mistake. Why may be that a mistake? Let's talk about tax equivalent yield. Earlier, I mentioned that I pulled up money market rates today. And as you noticed, these were money market rates that I was seeing on my screen. This was at about 10:30 this morning. On my last screen, I asked, do you want to earn 5.36 or do you want to earn 4.2? Something like that. I got that 5.36 from where you can see the yields are, at least this morning on money markets. And then I came over here and I looked at what municipal bonds were paying. And I used a municipal bond rate of 4.2%. Remember, municipal bonds, tax-free income from the federal level, whereas money market accounts are taxable to you. So let's take a peek at a quick case study here, okay? The way that you determine what is best for you, and you'll see this in the math, is exactly like this. Here's an example. You have a tax-free bond yielding 4.2%. That's a municipal bond. You have a taxable investment yielding 5.2. Those are the two data points that I'm going to use. I'll rephrase the question. I'll say to you, would you rather earn 5.2 or 4.2% on your money? The answer is very easy. If you're investing $100,000 and you earn 5.2, you would say, Derek, that's going to make me $5,200 over the course of 12 months. I would say back to you, that's correct. You would say, well, if I put it into the tax-free, it's only going to earn me $4,200 over the next 12 months. And I would say to you, that's exactly correct. And you would more than likely make the decision to invest your money earning 5.2. Question is that a mistake? Because it's not necessarily what you earn, it's what you keep. Now, the next variable that I'm going to bring into the mix is I'm going to say that these folks' tax bracket is 32%. Here's the formula. You take the tax-free rate. In this instance, the tax-free rate is 4.2. You divide that by 1 minus their tax bracket. So 1 minus 32. What this says to you, 4.2 divided by 1 minus, I might have did 35. I apologize. I might have messed that up, but still catch me out. Hear me out. Hear me out. What this is saying is it's saying to you 6.1% is what the taxable investment would need to be yielding, okay, need to be yielding in order to beat a tax-free 4.2. So think about that. Yeah, the investor put their $100,000 into that money market earning 5.2, but we'll just call it 33% of it disappeared to Uncle Sam, okay? So that $5,200 that they earned, 33% disappearing, 1,716 bucks disappeared to Uncle Sam, okay? Therefore, from that 5,200, they only put in their pocket $3,484. Therefore, they would have been better off in a municipal bond only earning 4.2. Why? Because they would have kept the entire $4,200 in their pocket. So the answer was they should have chose the municipal bond earning 4.2 unless they could find a taxable investment that was yielding north of 6.18. Sorry for the goof up there. So to give you another clue, because we're in 2024, I also wanted to point this out to you. These are the tax brackets for 2013, and below you can see the tax brackets for 2023, and below you can see the tax brackets for 2024. What you will notice, just so it's easy on the eye, let's focus on single, you'll see that the tax brackets have widened a little bit. What I mean by that is the tax rates are still the same, but if you notice, like a single person, look down here, they earn $600 more in the 10%. Look at the 37%, right? They're only paying taxes at 37% on their income above 609. So that was simply a data point I wanted to show you. For 2024, income tax brackets are getting larger. Now, if your income was exactly the same as it was in 23, you would be saving in taxes. My pointer came back. All right, so types of income, earned income, we kind of discussed it. Interest income, taxed at the regular income tax brackets. Dividend income, taxed at those more advantaged tax brackets. Capital gains, at least long-term capital gains, taxed at those more advantaged tax brackets. We talked a little bit about tax-exempt income. Tax-exempt income doesn't even apply to those tax brackets. And when you're looking at money markets today, okay, yes, they are attractive, but is a tax-exempt money market or a tax-exempt municipal bond portfolio better for you because you keep more of it? Now, I gave you earlier the 2023 versus the 2024 tax brackets. Let me also give you the 2023 capital gains and dividend income tax brackets. Again, they've widened. So if your income was exactly the same as it was in 23, as we go into 24, you would save money in taxes if you had capital gains and if you had dividend income, as you can notice here on the chart. They're simply widening. Okay. So let's talk about some prudent ways to help you reduce taxes. You probably want to consider these tips. First tip is investing using tax advantage accounts when possible. We'll discuss those. Inside of your taxable accounts, holding for the long term. By the way, I guess I should have made mention to that. That whole long-term gain, that whole dividend rate and all of that, that's applicable to your assets that are outside of retirement accounts. Of course, inside of retirement accounts, if you bought a stock for 10, sold it for 12, and you did that in a day, it really doesn't matter because it's inside of a retirement wrapper. Depending upon the retirement wrapper that it's in, you're taxed only when you take money out of that retirement account. So, you know, and that money that you take out of that retirement account, traditional IRAs, traditional 401k plans, so on and so forth, that's earned income inside of that bigger tax bracket, okay? Hold for the long term. I mentioned it earlier, long-term gains versus short-term gains. And consider tax loss harvesting. Also, tax bracket arbitrage. Don't worry, I'm going to dive into these things. So the first thing is invest using tax advantaged accounts when possible. The first thing that I'll say inside of here is I explained it earlier. I said, you know, you have a couple, they make 100 or 200 grand, it doesn't really matter. And I mentioned how it works its way through the tax brackets. Now, the government does give you a break. The government says to you, hey, before you throw your income into these brackets, we'll allow you to take deductions. Two different types of deductions, standard deduction or itemized deduction. The standard deduction for married filing joint for 2023 is $27,700. So again, if you had that married couple and their income was $200,000 for the year, before that $200,000 works its way through the brackets that you see above, if they took a standard deduction, only $172,700 $300 would work its way through that bracket because they took the standard deduction. Now, what if they itemized? Itemized deductions would be if you have deductions that are more than $27,700. What might those be? Those might be if you own a home and you're paying a mortgage and the interest that you paid throughout the course of the year was north of $27,700, you wouldn't take a standard, you would itemize. Now, some of you on the call are small business owners, and you may say, oh yeah, I itemize. That's different. That happens on one of your schedules. In other words, your business made $1 million, then you took all these business deductions, okay? And let's say you took business deductions of 900,000 because you paid employees, you paid rent, all of that stuff. So you were left with $100,000 of income. Depending upon the type of business you are, Schedule C or LLC, that dollar amount, that 100,000, would then end up on your 1040, just like you were an employee of any other company. And from there, you would either take a standard or an itemized deduction, personal, okay? The next thing that I want to talk about is tax advantaged accounts. What you can see on the chart here, tax advantaged accounts are one of the best tax deductions that you can have. Why? Because it's moving money from your right pocket to your left pocket. In other words, you're taking money that you have today or earned today, and you're simply moving it into a retirement account. For those of you who may know, back in 2023, you could put a maximum of $22,500 into your 401k account. If you were over the age of 50 in 2023, you could put 30 grand into your 401k account. For those of you who have 403Bs or 457s, those numbers are exactly the same. By the way, 403Bs and 457s exist inside of nonprofit organizations. For those of you who are government employees and therefore refer to your retirement account as TSP, it is no different. All of these are the same. Those are the dollar amounts. For those of you who maybe have simple IRA plans at work, I won't go too much into them, but you can still put money in. It's just at a lower dollar amount. And then, of course, there are IRAs or individual retirement accounts, and IRAs allow you to put money into them. For 2023, you could put $6,500 into your IRA, and if you're over the age of 50, you got $1,000 catch up, so you could put in $7,500. Now, before I go on, let me say this. You have to have earned income in order to put money into your retirement accounts. But no different than I said before, let's go back to that couple who made 200 grand. Now, let's pretend they took the standard deduction, therefore reducing that $200,000 down to $172,300. $172,300 worked its way through those brackets. Now, let's pretend both the husband and the wife, who, let's just pretend they're under the age of 50 and they both maxed out their 401k plans, okay? Well, if you think about that, that 401k plan came directly off of the top. So now they made 200, took the standard deduction, both maxed out their 401k plans. What's left? 127 grand. Only 127 grand is now working its way through those brackets. Of course, if they were over the age of 50, they could put in more. And before I go on, people tend to mitigate their IRAs. However, regardless if you maxed out your 401k, regardless if you maxed out your simple plan, regardless of what you did on that side, and regardless of your income, you can always contribute to your IRAs. Now, when I say you can always contribute to your IRAs, and people on the call may be like, so you can always contribute to your traditional IRA. I personally do that every single year. The question is will that be tax deductible or non-tax deductible? Again, you must have earned income. So if you're retired and you just have social coming in, even though social's taxed at those federal income tax brackets, it's not earned income, it's 1099-G income, right? But you can always stick money into your traditional IRA. The question is whether you'll get a tax deduction or not. Even if you don't get a tax deduction, it is still beneficial to make the contribution to the IRA. You will not pay double taxation. You'll be moving money that would otherwise be taxable to you into a more tax-friendly realm. Roth IRA plans impose income limitations. In other words, if you earn over a certain dollar amount, you cannot contribute to a Roth IRA. There is the whole concept of a backdoor Roth IRA, which I won't go into today, okay? But you can still get money into a Roth IRA via what is called a backdoor Roth IRA. And that is exactly why I contribute money to a traditional IRA, and then I immediately convert it to a Roth IRA, therefore completing what is referred to as a backdoor Roth IRA. Let's keep working here. Just as a heads up, if you are a small business owner, in other words, you own the company, I just mentioned earlier, if you're under the age of 50 in 2024, you can get in 23,000. By the way, that's that number. I didn't update it for 2024. If you are under the age of 50, you can get in $23,000. What I have here? Oh, 23,000 if you're under the age of 50. If you're over the age of 50, you can get in 30,500. If you're the owner of the company, if you're on the webinar tonight, you own a company, you can get in up to 66,000. That's a whole discussion in and of itself. I won't go into how that works, but just know you can get in more. And if you're over the age of 50, you can get in $73,500. By the way, for anybody who owns a business, if you're on the webinar tonight or you watch this webinar at a later date, this is what you can get into a retirement account. You can also slap on top of that an additional retirement account, and depending upon your age and your income and your census, quite frankly, we could show you how to get in upwards of 250,000 between the combination of a 401k plan and a small business pension account. IRAs for 2024, under the age of 50, 7 grand, over the age of 50, 8 grand. You saw that on my last slide. Again, 2024 contribution limits, you can see them here. One thing I want to talk about very quickly is I want to talk a little bit more about IRAs. Why? Back in December of 2022, President Biden, through his passing of the Secure Act, also put inside of the tax code the Savers Credit. Now, before I go on, just note, we're talking about IRAs. You have until April 15th of 2024 to fund money into your IRA for 2023. So just because we're past the calendar date, you still have the opportunity to fund money into that IRA. I shouldn't have said traditional, IRA, whether it be Roth, whether it be traditional, whether it be a backdoor Roth. If you want to talk more about that, you absolutely can. Just schedule us, schedule me, what the case may be, and we'll unpack that for you. However, typically speaking, people want to get money into their Roth IRA because of the tax-free advantages of it. Well, when you put money into a Roth IRA, you do not get a tax benefit. You do not get a deduction on your tax return. However, in 2023, if we look at a married filing jointly, let's pretend that they've put money into a Roth IRA plan and their income, taxable income, is below certain dollar amounts, they can get up to $1,000 tax credit. Another $1,000, just it's a credit in and of itself. So it's even better than a deduction. Okay. Yeah, I know some of you might be laughing because you think about it and they pass these saving credits and you think about lower income earners, okay, and you go, geez, how could they ever afford to put money into their retirement accounts? And I agree with you wholeheartedly. But again, this is something that in the past didn't exist. Now let's just pretend for a moment that you have somebody and they dropped $5,000 into their traditional IRA. They got the full tax deduction for that, but it went inside of an IRA. And if it went inside of an IRA and they put 5 grand in and their income, let's just say they were single, was less than, if it was less than 36 grand, they can get up to additional $1,000 tax credit. The savers credit will also be around in 2024. I didn't put a slide on it, but no different than those income tax brackets, the amounts are going up. So you could earn more, which is a good thing, and still get a savers credit. Very nice on the account, okay? Next, health savings account. Sorry for how small this is. If you have a health savings account available to you, and if you have it available to you, you have to have a health plan that works with it, but you can throw money into an HSA account. That money is 100% tax deductible. There are rules that go along with it. I'm going to cover those rules very quickly. In order to contribute to an HSA, you must be enrolled in an HSA eligible health plan for 2023. By the way, the reason why I'm bringing up 23 is similar to the IRA. You have until April 15th of 2024 to put a contribution into your HSA. By the way, even though I say you have until April 15th of 24 to do both the IRA and the HSA, what many of you have heard me say, you have until the day you file your tax return. Here's why I say that. Let's pretend you file your tax return today. You haven't funded an IRA, you haven't funded your HSA. Well, if you have a CPA preparing your tax return, or if you're doing it yourself, in your tax return software, it asks you the question, did you put anything into an IRA? And you hit no, because you didn't. And that may also ask you, did you put money into a health savings account? You hit no. Why? Because you didn't. Well, now all of a sudden you're in this presentation and I tell you this, and so you go and you throw money into both your HSA and your IRA, but you already filed your tax return for 2023. Okay. You wouldn't get the deduction. You'd have to file an amended return. However, I also bring it up because of this. Some people know this. So they go to file their tax return today and they say, yeah, I threw $7 grand into my IRA and I threw $4 grand into my HSA, okay? But they haven't done it yet. Well, they're fine. They filed their tax return today. They answered the questions yes